welcome to Macros with Mythili, where we take a hard look at all the major macroeconomic developments and challenges before the country. Well, what we're going to discuss today can hardly qualify as a macroeconomic development in India, but it is going to test us as never before. Over the next half hour or so, we're going to discuss the recent decision of the US Federal Reserve to end its quantitative easing, or the program under which the US Central Bank bought bonds and treasury bills to infuse additional liquidity into the US system to try and spur economic growth. Its implications for countries like India, whether we need to worry at all about what the US Fed does, and most important of all, how can we best equip ourselves to deal with the consequences? And joining me in the discussion are two of the best qualified to throw light on the subject. Subir Gokarn, Head of Research, Brookings India, and a former Deputy Governor of the RBI, and Alok Sheel, a senior civil servant and prolific writer and columnist. Alok has also represented India at the G20 during the days when the G20 had not quite degenerated into the talking shop that it now seems to have become. Welcome to the show, gentlemen.
Thank you.
Alok, if I can start with you. Are you a little surprised by the relatively muted response to the US ending its tapering? In fact, if you look at the Sensex and the Nifty, they seem to have gone up today rather than down. What explains this kind of reaction?
The decision of the Fed to end its taper was not only widely expected, but it was also announced earlier that it would end in October, November. So this hardly came as a surprise. What would have come as a surprise is if the Fed had made any statement regarding raising interest rates, which it did not. In fact, it just reiterated its forward guidance. Now, the initial reaction of Asian markets, the emerging markets in Asia, was that the stock markets by and large declined, although they recovered later. The advanced markets in Asia, that is Japan and Australia, the markets actually rose. So basically the response to the US Fed announcements was twofold. Those countries who were looking to revival of growth and demand and greater Fed confidence in the US recovery saw an increase in the stock markets and confidence. The ones who would be affected by capital flows, that is emerging markets, they saw an initial decline. But since this was widely anticipated, the markets recovered.
Subir, would you agree with that assessment that because it was expected that the tapering would end this month, or is it because it's a lull before the storm? Why have Indian markets gone up? Because after all, we also are heavily dependent on capital flows.
Well, there is that element, that dimension, but I also want to bring in another dimension. The 10 billion a year reduction starting December, since the magnitude of the QE was $85 billion bond purchases every month. If you reduce it by $10 billion a month, you're going to get to zero in 8 months, and basically that's what's happened, maybe a month or two plus or minus. So it was a completely anticipated eventuality. Something like our diesel price hikes, 50 paisa a month, you'll eventually get rid of the subsidy, and that's what's happened. So it's been fully internalized into all calculations. From the vulnerability side, and looking at it from India's perspective and the impact that it has had on Indian markets, look at the huge difference between our external sector picture 1 year ago and now. On the external account, we are far less vulnerable, far more buffered than we were a year or a year and a half ago. And so whatever happens outside, even if there is a significant shock, its impact on domestic markets will be relatively more muted because the vulnerability is that much less. So both factors, I think, have contributed to this essentially being, from India's perspective, a non-event.
Alok, Subir said there's one more reason why we've not been so affected, in fact why the markets perhaps have gone up, is because our fundamentals, particularly on the external side, are much better than before. But if you look at our current account deficit, a great deal of the improvement is contrived. It is not genuine in the sense that we have restrictions on on gold import, oil prices have fallen. So is that a sustained improvement, and can one really count upon it? Can we genuinely say that we're out of the woods as far as our macroeconomic fundamentals are concerned?
Yes, you're quite right in that, you can have an improvement in the current account deficit through a surge in exports, or you can have it in a decline in imports. And certainly our improvement in the current account deficit is on account of the latter. Part of it is a decline in gold-related imports, the reduction in oil prices. But yes, you're quite right in saying that it is not the the very robust improvement in the current account, and the same goes for some other macroeconomic parameters. For instance, inflation has also is consistent both with lower inflation is consistent both with a sound macroeconomic position or a decline in demand. So both these parameters, both inflation and the current account, are very positive, but much would depend on the underlying macroeconomic situation, how they are to be interpreted.
Subir, as far as the QE is concerned, yes, the QE has ended without, it's ended almost with a whimper. But do you think that markets are now fixated on when interest rate cycle will reverse in the US? And that's what we have to watch out for. What is your sense? When do you think that will happen? In the first quarter of 2015, the second quarter, or do you think the Fed will remain dovish for much longer?
Well, I was reading the commentary on the Fed's announcement, the statement that was issued after the meetings. And there was some tone in the some sense in some of the commentary that I saw that was expressed a little bit of surprise on the relatively hawkish nature of the statement. In particular, its reference to the significant improvement in employment conditions, or the decline in unemployment being somewhat more rapid than was expected. My own sense is I can't really, I'm not observing the US economy that closely to be able to second guess this particular judgment. But I think the issue here is again something that is central to the global economy, something that is critical to our own macroeconomic prospects, is whether the oil price decline that we've seen over the last 3 months, and it's a very, very substantial decline from $105 a barrel to now somewhere between $85 and $90 a barrel, whether this is going to sustain or not. If it is going to sustain, and I think there are reasons to believe that it will, then that actually creates capacity for the Fed to be talking fairly hawkishly about improving economic conditions, rapid decline in unemployment, inflationary risks sort of starting to rise because of demand conditions improving and so on, and yet not have to raise rates because the decline in oil price is actually offsetting all of that. So it's a relatively fluid situation.
But the situation is very fluid, as you pointed out. But I'm afraid on that note, we have to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the implications of the US Fed's decision to end its quantitative easing. Alok, before took the break, Subir is talking about the situation being very fluid. And yes, he's entirely right on that. But how do you read the US Fed's forward guidance?
The US Fed's forward guidance of no increase in interest rates for a considerable period of time going forward. I was reading an assessment by Morgan Stanley on the market expectations of when the US Fed would raise interest rates. And recently, over the past month, that has actually increased by about 2 months. It's, I think, currently around maybe 12 to 14 months is the market expectation. Between the Fed tapering its or ending its expansion of its balance sheet and raising interest rates, the number of intermediate issues in between. The first is the reduction in the balance sheet, the rollback, and the other issue is the large amount of reserves that depository institutions have parked with the US Federal Reserve. So both of these issues are going to play as important a role as the Fed fund rate going forward. And during the current FOMC meeting, there was a reference to the New York Fed having increased its reverse repo operations. which gives an indication how managing liquidity is going to be very important going forward, even before the Fed raises interest rates.
Subir, would you agree that India has benefited enormously from the surplus liquidity, as it were, in the US, because we've seen huge capital inflows, but the fear of this reversal A has come down, and B, even if the flows do reverse, a revival in the US economy means Indian exports will do much better, and our current account position will be much more sustainable, much more healthy in that scenario.
Yeah, I think I go back to my previous response, which is I think the rollback in U.S. liquidity is a contributory factor, significant contributory factor to the dynamics of commodity prices. It's not the only reason why oil prices have come down, but it is a significant contributor to that process. And in a sense, the fact that the U.S. economy is recovering is adding momentum to the benefits that lower oil prices are providing India. So it works very simply that if we have a lower current account deficit, the vulnerability of the rupee to shocks, to external shocks, whether these are commodity shocks or capital flow shocks, is much less. So there is a lot more stability in the currency now. And when investors look at India as an option, for 3 years before, from 2011 to 2013, the currency risk was a huge negative factor in their calculations. Any returns they might expect on the rupee front were being offset by perceptions of currency movement, and that came in turn because of the size of the current account deficit. So now you don't have that factor playing a role anymore. The current account deficit is narrow. Even with issues relating to sustainability and so on, bottom line is when oil prices are low, the current account, the risks of current account, the deficit widening are that much lower, and so you can take a very benign view of currency risk here. That means that more money, wherever it is, wherever it's coming from, is likely to flow into countries like India, which have relative macro stability at this point. And that is a positive. And then you're looking, as you said, at the prospects of increasing demand for Indian exports in the US, which is recovering. So all of these factors are actually contributing to virtuously.
Alok, you've been representing India in the G20 talks. Given the kind of improvement we're seeing not only in India but also in global macroeconomics, barring of course Japan and the EU, do you think institutions like the G20 have lost their relevance? Will it become like the non-aligned movement, completely redundant, or is there still a role for the G20?
Well, I would not agree that there has been a big improvement in the global economy. Really, it is in the United States which is really the bright spot in the global economy today. If you look at Japan, you look at the slowing of growth in China, and then you look at the major economies in the Eurozone, and then you look at the BRICS. So growth is badly impaired in all these areas. And the bright spot in the global economy today is the US, and going forward among emerging markets, I think now the Indian story is being sort of rewritten, and the G20 is responding to this, or has been responding to this very gradual and slow recovery from the crisis by focusing less on short-term macroeconomic management and focusing on what sort of structural reforms can be done by the various economies to raise global growth. Now the G20 was more effective during crisis times when everybody was in a panic mode, and once a consensus was reached within the G20 and in consultation with the IMF what needed to be done, all countries went ahead and did it. I mean, no commitments were asked for, no commitments were given, but they all resorted to monetary and fiscal stimulus. But the exit has been more divergent, and each country is responding according to the domestic debate, and what is the domestic consensus, and that is what is going to happen. Each country, you will have a commitment, and most of these commitments are actually what countries have already committed to in their own domestic, domestic political environment. And so we have to, see to what extent and at what speed these structural reforms are carried through.
Absolutely. Each country looks to its own backyard. That's very clear. Even the US is not really concerned so much about the external tailwinds. But I'm afraid on that note, we have to slip into another short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the implications of the US Fed's recent decision to end its quantitative easing. So we're even assuming that, the things do turn out to be more positive, as you have, talked about just before the break we took. What do you think? Do we really need any defenses at all to kind of guard ourselves against any possible reversal of capital flows? Or are we sufficiently well placed, as it were?
I think our best defense against sharp, sudden reversals of capital flows is our macroeconomic stability. So there's no lack of alignment or misalignment between our external sector objectives, which is buffering ourselves, protecting ourselves against external shocks, and our domestic compulsions, which are to have low inflation, have a manageable current account deficit, have a manageable fiscal deficit, particularly a fiscal deficit that is focused on capital expenditure, on creating infrastructure as opposed to financing consumption by government. So this is, to me, a very straightforward, simple approach to protecting against external sector risk is keep your domestic macro situation under control. In addition to that, of course, we need to have some protection. I think we've got protection in the form of reserves. That's always there. You have to, use them judiciously, and in situations where the shocks are particularly sort of likely to be temporary but still disruptive. The narrower your current account deficit is, the more protection you have against virtually all kinds of external shocks. But I think the risk factors that we've got to be a little conscious about, one is, is the oil scenario here to stay? And if it remains in this position, if oil remains in the 85, 90 or even slightly higher, I think we've got a really good long-term opportunity here. But if it is subject to a sharp upward movement for whatever reason, if you look at global forecasts of oil prices now, there's an overwhelming swing towards moderation. There are very few people I've seen who are looking at a sharp reversal in oil prices on a sustainable basis. So that is really what gives me the basis for being relatively optimistic about this whole situation. With US shale kicking in on the supply side over the next 2 or 3 years, it's very difficult to see how oil prices can spike back up to well over $100 a barrel on a sustained basis. There may be temporary shocks. Now that is, I think, taken us back to a kind of macro scenario which we saw in the early 2000s. Oil was, of course, much lower then, but in relative terms, I think we have that opportunity. That is a good external situation, very, very benign external situation on this side. US recovering is going to drive export growth. India growing faster than many other emerging economies is going to keep capital investors focused on India. In relative terms, it is looking like a reasonably good bet. All of these are positive. Combine that with some fiscal improvement and inflation coming off, I think we've got the makings of at least the macro preconditions for a growth acceleration here. The question is, can we trigger this by accelerating some of the structural reforms? I keep coming back to that point that the macro right now is giving us an opportunity that we last had in the early 2000s, and we shouldn't be in any way wasting it.
Okay. Alok, would you share that assessment that Subir has just listed, that really fairly positive outlook for India at the moment, and really the best defense in the case of any reversal or any untoward incident is really strong macroeconomic fundamentals, and the fall in the oil prices has given us a wonderful golden opportunity to cash in and push through all those reforms. So are we well placed to cash in really on that opportunity?
Oh, absolutely. I think the fact that fundamentals play a big role in how the economy responds to an external shock, or how, let us say, external investors respond at the time of a sudden stop, because they have to take a call as to from which countries they're going to pull out first, and those are affected worse. We can see the difference in 2008 and May 2013, when the Fed first announced its intention to start tapering. In 2008, at the time of the global financial crisis, India was among the least affected of the emerging markets. Whereas in May 2013, when our fundamentals had deteriorated. In 2008, by the way, our fundamentals were very good. By 2013, our external account was the current account deficit was large, inflation was high, and growth was dipping below 5%. So India was among the worst affected major emerging markets. So now we seem to be in good shape, whether we measure in terms of growth, relatively speaking. But of course, we are talking only of the last quarter growth. We have to see, the next few quarters as well, whether to what extent it stands up. The current account has vastly improved. Inflation is down. Then the prospects for oil prices, which is a vulnerability on the current account, the prospects for that look good. So really, India is one of the best emerging market stories, and certainly within the BRICS.
Yeah, one of the best emerging market stories, certainly, but we're almost running out of time. So Subir, before I wrap up, I'd like to quickly ask you, what is the one most important thing you would like the government to do to really capitalize on this opportunity?
It's not just one. I think there are 3 or 4 that need to be, we're starting to see some action. Food inflation, very positive developments on the short-term responses, but structural changes are necessary, reorienting procurement and so on. Infrastructure, getting the PPP framework back in gear, it is completely broken at this point, and there are a number of things that need to be done. The Make in India translating into large employment generation opportunities in manufacturing, all big challenges. We've been dealing with them for many years. We've got to see, I think, much more momentum and coordination on these fronts.
Alok, would you like to add to that list that Subir has just kind of given us?
Yes, I would mostly agree, and I like to say that there are really 3 Brahmastres that need to fire. And I mean, there are a lot of reforms that need to be done, but the 3 big issues, one is a reform of agriculture that would address the issues of inflationary pressures coming from the the food side, and the second is to get labor intensive manufacturing going. Now that will have another a slew of measures to get that going, and the third is a mix of infrastructure and fiscal reform. You need to create space in the fisc for a big drive on infrastructure, public infrastructure investment, and alongside that, of course, private investment, public-private partnership in infrastructure. So infrastructure with a good component coming both from the budget as well as from PPPs, because we have a huge deficit. So these 3 things, I think, are the 3 big things that need to be done to get growth back at a high level on a sustainable basis.
Okay, 3 Brahmastra suggestions from Alok, but I'm afraid that brings us to the end of this episode of Macros with Mythili. Alok might not be as positive as Subir, but both are agreed that we have a rare window of opportunity and we need to cash in on that to utilize this opportunity to take the economy to the next stage of growth. Thank you so much, Alok, as well as Subir, for joining us in this very important discussion. Thank you also for watching. We'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.